To family, welcome to the Stocks with Josh show. I've got a really good video for you guys today. I'm up on the rooftop of the building I'm staying at in Barrancos, Peru, but I've been researching all day and I'm excited to share some of my findings with you guys. The markets moved up today, back above that 4,100 level, which I've told you in the past is critical, and they're optimistically looking forward to tomorrow's CPI data report, Consumer Price Index, which measures inflation. Our Valentine's date with the inflation report is tomorrow at 8:30 a.m. Eastern Standard Time. Now, this is going to show us how quickly inflation is cooling off or isn't. Right now, the market's been operating bullishly off of the last CPI report, which came right in line with expectations. CPI, the last time, it had to drop at its fastest pace for the year, down a total of 6 points to please the bulls, and that's exactly what happened. And the markets, they took off like a rocket. So what does it have to do this time around? What is the market expecting right now? The market is expecting that inflation is no longer a problem, that the worst is behind us, and that makes the Fed predictable. The bullish narrative is that the rate hikes are working and inflation and the Fed are totally tamed. For that assumption to continue, CPI headline inflation has to come down, this time just 3 points to 6.2. It was 6.5 for December, down 6 points from 7.1, but this time it needs to come in at 6.2. If it comes in line with expectation, I really don't see why this micro bullishness in the market would end. We could easily see a pushback up on the S&P 500. If inflation, though, is higher, let's say it's only 6.3, I think that would spook the markets, it would be too unpredictable, and we would see a pullback, possibly down to that level of support at 4,000 that I've been talking to you guys about for the last couple of days. We don't have to guess what the Fed will do if the CPI doesn't come in at least at 6.2. He's already told us that if inflation doesn't slow down, he's going to raise rates higher and higher and higher than the market is expecting. And the buying that we saw today proves that has not been priced in right now. So what stocks were moving the most today? Well, it was big tech again. Tech was once again leading the markets higher. Specifically, Microsoft started off this morning with a 3% pop and then ended the day with a near 5% move. I want to take a quick peek at Microsoft. In my video, January 9th, I did a comparison between Google and Microsoft, and I told everybody that Microsoft, fueled by their investments in ChatGPT, was on the move. The Microsoft price that day was sitting at $226. I got to admit, my timing was extremely good. That day, I called Microsoft a buy, even though over the last week or 10 days, it had actually been on a downtrend. I happened to pretty much call the exact bottom that day when I had been researching and investing that stock, and from that point forward, it has been moving up. It hit a local high of $276, which was a 22% pop. The question is the run for Microsoft over? Now I'm going to give you guys some fresh technicals and price predictions for Microsoft right now. Microsoft has had its blasters on for the last 30 days, pushing higher and higher like a lot of other big tech companies. But I think the fuel is going to run out if they were to get to $280. I want to compare this prediction with one of my previous predictions for Tesla. Now, I said when Tesla was getting up very high to their peak, I said that 208 would serve to be a strong resistance. I told everybody that if on the day that it broke above 208, it sold off beneath 208, that it would continue to fall. Now, I think the same thing about Microsoft and that $280 price mark. If it goes up above 280, doesn't matter where it goes, if it sells back beneath 280, I think we'll see Microsoft topple from there. To me, that's the peak, that's the top. I'm going to be personally buying puts on Microsoft. At that point, I'll be watching it. Maybe I'll get in at 285. Maybe I'll get in at 287. But I'm going to be watching that for a breakdown, and I'm going to be looking to pile in and go short. Everybody always asks me, Josh, what's your strike price? What's your expiration? Now, I'm typically only going out about 3 weeks, and I'm typically just slightly out of the money. I actually only intend to hold my options for a couple days. So in my view, the actual option that you get has a little bit more to do with what you can afford and what your risk tolerance is. So if you have a lower risk tolerance, you might want to go further out or go further in the money. But in addition to my risk tolerance being relatively low, if my technicals are too early, they don't go the way that I expect them to do, I will cut my losses, I will get out of it, and then I'll just sometimes a day or two later, when it comes in line with what I was expecting it to do, I'll just jump back in. So that's what I'm doing. Remember, this is not a suggestion for you guys as to what you should do. This is just for educational purposes. I take you along on my trade journey and on my research journey. I've got some more gems to unload today for you guys, but take a moment and hit the like for me. Go ahead and subscribe if you don't want to miss out on these daily stock and crypto videos. I need to take a moment to acknowledge my Palantir call that I made yesterday. I explained it was at a pivotal moment and that it was a do or die for the stock. I actually favored it getting a nice little pop. If the earnings and the forward guidance was good, I said that it would see a pop after hours to at least $9, and that's exactly what we got. This was the first quarter that they've posted a positive net income. The only thing more that I want to say about Palantir moving forward is that I believe that the $8 range has formed an absolute strong historic support. And so you have to keep an eye on it. If that $8 range for any reason gets lost in the future, that's the smart money turning away from the stock again. So just keep that in mind. I personally believe that it's bullish moving forward if it stays above $8. All right, so I'm going to break down today the bull versus the bear case overall as I see it in the market. Before I do, if you guys need better trade tools, go to the link in the top pinned comment to get the Moomoo investment app, open and fund an account, and you can get up to 15 free stock, as well as the fact that you can come over and find my chat group that I host on the app called Stock Josh Fam. Get your free stock, start investing today, and then come find us in the chat. Okay guys, so the CPI data that we get tomorrow is actually pretty critical to validate a move higher right now in stocks. Everybody's trying to figure out, is this a bear market rally or is this genuinely a bull market? And I want to take a moment to re-examine the points on both sides from my view of deep diving the research, because getting it right is going to be the difference between making or losing a ton of money. I'm doing that research for myself initially, but then I'm coming on here and sharing it with you guys so you guys can win. The bulls basically believe in three ideas, and I'm going to break them down for you. Number one, they believe that the U.S. can avoid a recession. The bulls do not believe we're going to have a recession in 2023. Number two, they believe that the Fed will either pause, pivot, or ease in 2023. And number three, they believe that corporate earnings will do way better than anybody's expecting. So I want to break down the bullish argument point by point. And analysts point to the fact that the last 2 quarters of 2022 was evidence that the economy is getting stronger and not weaker. As evidence, the GDP actually increased to 3.2% in the third quarter and 2.9% in the fourth quarter. It was not negative as some thought it might be. There is also the belief that big tech is doing great and that the layoffs that they're guiding towards are actually only going to serve to improve their profit margins in 2023. So when the economy does not fall into a deeper recession, they believe that most of big tech will emerge even stronger. Another bullish point is that consumer spending has not slowed down very much. There was a slowdown in retail spending, but it was only 1%, 101% year over year. It wasn't 5, 6, 7%. A little, but not a lot. And they talk about the inverted yield curve is only a result of the Fed's unusually aggressive speed in raising rate hikes. The Fed raised rates from 0 to 4.75 in 2022, which they say was abnormally quick. And the final argument is that the Eurozone and the Chinese recessions that people have talked about have yet to materialize. Both economies are showing great resilience. In addition, China and Japan are doing the financial easing, which I brought to you guys some time back. They believe that that's going to further boost their economy. The argument had been that their potential poor performance would drag down the US, but so far they're not doing that bad. Matter of fact, the Eurozone grew at a rate of 3.5% for 2022, and their inflation fell to 8.5% in January, down from its peak of 10.6%. And in China, the world's second largest economy, they grew by 4.4% in 2022, which was way better than expected. So how do I interpret all of this? Have these arguments convinced me that there's not going to be that downturn to 3,300 on the S&P 500? I'm undecided at the moment. I'm still studying it. but it does remind me of one of my own arguments that I shot out in a video over on Larry's page a couple weeks back, which was that the economy has really never been through anything like the COVID and the excessive COVID relief spending. So this may be an unprecedented and an unpredictable moment. I've also said on a recent video that we can't be headstrong. Our goal is not to be right, our goal is to make money. And so one of the real considerations that I think that we have to add to our view of where this market could possibly be going in 2023 is the idea that it could actually be going nowhere. That we could actually go up and down and then remain range bound, moving mostly sideways till the end of the year, starting the year and ending the year roughly somewhere between 3,800 and 4,200. If that happened, then it would basically mean that the economy would be avoiding recession and corporate earnings would remain largely flat over the year. If this alternative to a bull or bear scenario proves to be right, traders or investors who get overly bullish or overly bearish, those are the ones who are going to get wrecked. If this idea is true, it could be a great environment for swing trading and day trading, and even long-term investing, because we will have high volume and high volatility and swing from a low to a high repeatedly throughout the year. This is definitely, though, a contrarian view, because really most of Wall Street right now in a recent consensus said, at least 65% of them, believe that a recession will occur. The only thing that could tip this dramatically one way or the other would be, such as the jailbroke version of ChatGPT pointed out yesterday, would be the tensions, the escalating tensions between the US and China, some unforeseen black swan event. In addition to that, there's at least two other noteworthy problems that we have to keep our eye on. One of them being the stalled action on lifting the US budget debt limit. I'm not going to get into that here. And number two is that inflation stays higher for longer, which brings us back to the importance of tomorrow's CPI report. An attractive trade at the moment, I think, is the VIX. At this moment, it's unusually low, and there may be an opportunity there for some call options. I made a point in my video yesterday, there's going to be a rotation in stocks to defensive stocks and bonds. That is a more sure thing. I think the bears are going to be the ones looking right in the next 2 weeks or so. I think that we are going to get a 10 to 15% decline from our current overall levels. Here's where the bears are going to potentially err, believing that the markets are going to go down more than the data is proving right now. One thing is certain at this particular level of 4,200 on the SPX, the market is not pricing in a recession. If we're looking at PEs, the market is trading more than 18 times 2023 earnings estimates, which means that if we do have a recession, stocks right now are very expensive. The bears fundamentally believe that the sooner the recession is priced in and that we get down to 3,300 on the SPX, that measures the S&P 500, that's the sooner that the markets could do a real recovery. And even though that's what I would love to see for myself, the markets are not giving that to us. And so I believe very strongly that we have to trade the markets that we're in, not the ones we want. That's it today, guys. Hit the like, the subscribe to stay connected. I wish you all great success in your trading. As always, peace and blessings, my friends. I'll see you in the chats.